For 15 straight years, index funds were the smartest thing you could own. From 2009 to 2024, the S&P 500 delivered an average annual return of roughly 13%. If you put $10,000 into a basic index fund at the start of that run and didn't touch it, you ended up with somewhere around $65,000. No stock picking, no expensive advisor, just patience and a low-cost fund. The strategy worked so consistently for so long that questioning it started to feel like a personality flaw. But here's what that 15-year track record didn't prepare you for. The same mechanics that made index funds so powerful during that run: the automatic buying, the rules-based allocation, the relentless inflows from millions of 401k, quietly built something else underneath the surface, a concentration that most investors have never examined, a feedback loop that works beautifully, going up and brutally going down, and a structural fragility that only becomes visible when conditions change. This video is about that gap between the track record you've been shown and the architecture you've actually been invested in. My name is Alex, and if you've ever assumed that a decade of strong returns means your portfolio is built on solid ground, stay with this. Because past performance and structural resilience are two completely different things, and most investors have been handed one while believing they have both. Understanding the difference could be the most valuable thing you do for your financial future this year. The index fund isn't broken, but the version of it sitting inside most retirement accounts right now is carrying risks that the brochure never mentioned, and the last 15 years never forced anyone to confront. It starts with a word that gets used constantly and examined rarely. It starts with the illusion of diversification. The most expensive mistakes in personal finance rarely look like mistakes when you make them. They look like responsibility. They look like discipline. They look like they're following the advice of every credible source you've ever encountered. And that's precisely what makes them so difficult to catch. Not because you weren't paying attention, but because the problem is buried inside something that was sold to you as the solution. Meet Daniel. He's 38, a project manager at a mid-sized logistics company in Ohio, pulling in around $87,000 a year. For the past 9 years, he's contributed 12% of every paycheck into his employer's 401k. That's his workplace retirement account. He chose the default target date fund because the HR onboarding materials described it as broadly diversified. He's never missed a contribution. He's never chased a hot stock tip. When the market dropped sharply in 2022, he kept his head down and kept contributing. Every financial habit Daniel has built is exactly what the textbooks prescribe. He is, by any reasonable definition, doing it right, and yet sitting inside that carefully maintained, responsibly managed, broadly diversified fund is a bet Daniel never consciously made. Here's what's actually in there. A standard S&P 500 index fund, the kind sitting at the core of most target date funds, currently allocates roughly 35 cents of every invested dollar to just 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. 7 names out of 500. The remaining 493 companies share what's left. Now run that through Daniel's actual numbers. Over 9 years, contributing 12% of $87,000 annually, Daniel has put in somewhere around $94,000 in total contributions. Of that, approximately $33,000 has flowed, automatically, mechanically, without his input or awareness, into those 7 companies. He didn't research them. He didn't choose them. He filled out an enrollment form and trusted the word diversified on the label. That trust isn't naive. It's reasonable. The word diversification carries a specific promise that your risk is spread across many different companies, moving in different directions, so that no single failure can do serious damage to the whole. That promise is what makes the strategy feel safe. And for most of the fund's 500 holdings, it more or less holds. But 35 cents of every dollar isn't diversified. 35 cents of every dollar is a concentrated position, one that Daniel inherited without a conversation, without a disclosure, and without a choice. Here's why that matters beyond the numbers. Those 7 companies, despite appearing to operate in different areas, are not independent bets. They are large-cap American technology companies, or companies so deeply embedded in the tech economy that they move like one. When conditions shift, they tend to shift together. A change in interest rate expectations hits all of them. A regulatory development targeting big tech hits all of them. A broader loss of confidence in AI-driven growth narratives hits all of them. What Daniel thinks he owns is a stable, diversified slice of the American economy. What he actually owns is closer to a leveraged conviction that US large-cap technology keeps outperforming everything else indefinitely. Maybe it does. That's genuinely possible. But a conviction that large requires a decision, and Daniel never got to make one. This is the illusion at the center of modern index investing. Not fraud, not negligence, just a quiet, structural reality that the label never quite captures, and that most investors only discover when the conditions that hit it finally change. Which raises the obvious next question: how concentrated is the risk, really? Because once you look past the 500 company headline and examine what's actually driving the fund's performance, the hidden concentration becomes something you can't unsee. Owning 500 things doesn't mean you're protected by 500 things. That distinction sounds simple. In practice, almost nobody applies it to their retirement account, because the mental model most people carry that an S&P 500 fund gives you 500 roughly equal slices of the American economy feels intuitively correct. It's the image the marketing materials encourage. It's the image the word index naturally conjures. And it's meaningfully wrong. Here's what the actual distribution looks like in early 2026. The top 10 holdings in a standard S&P 500 index fund account for approximately 37% of the entire fund, the top 7 alone. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla carry a combined weighting that eclipses entire sectors of the economy. Utilities, materials, energy, and real estate add all of them together, and they still don't match the concentration sitting at the top of the index. So on a day when the market rises 2%, it's not 500 companies having a good day. It's mostly 7 companies having a good morning and pulling everything else along with them. Now here's the part worth slowing down for. Those 7 companies feel genuinely different from each other. Apple makes consumer devices, Amazon runs logistics and cloud infrastructure, Nvidia designs the chips powering artificial intelligence, Meta sells digital advertising. On paper, these look like separate industries, separate supply chains, separate customer bases, separate risks. But stock prices aren't driven by what a company makes. They're driven by what investors believe a company will earn, years into the future, discounted back to today. And that calculation for all 7 of these companies runs through the same set of variables. Interest rates are the most direct example. These are long-duration assets. Their valuations are built on projected earnings stretched decades forward. When the Federal Reserve raises rates, the present value of those future earnings falls, and it falls across all 7 simultaneously. In 2022, when the Fed executed its most aggressive rate hiking cycle in 4 decades, the concentrated top of the S&P 500 didn't diversify the pain. It concentrated it. The index dropped roughly 19% that year, dragged disproportionately by the same names that had driven its gains in the years before. Artificial intelligence spending is another shared variable right now. The current market is pricing in a sustained, multi-decade AI infrastructure build-out, and these 7 companies are positioned as its primary beneficiaries. That belief is already embedded in their valuations, which means the risk isn't just that AI disappoints, it's that any meaningful revision to that narrative hits all 7 names at once, simultaneously, with no offsetting positions elsewhere in your diversified portfolio to absorb it. Think of it this way. Daniel, the project manager from the last section, effectively owns a portfolio that has 2 layers, a thin layer of genuine diversification across hundreds of smaller companies, and a thick layer of concentrated exposure to a single thesis. That large-cap American technology continues to outperform everything else, in every rate environment, through every regulatory cycle, indefinitely. That's not a balanced portfolio. That's a balanced portfolio with a very large, very specific side bet attached to it. One that Daniel, like most people, never consciously placed. Here's what makes this more than an academic concern. The concentration didn't happen because someone made a bad decision. It happened because of the way the system is designed, because of a mechanical process running automatically in the background of every index fund, every pay period, without pause or reflection. Understanding that process is what makes the whole picture click. And it starts with what might be the most important and most overlooked engine in modern markets. It starts with how the escalator machine actually works. A machine that only runs in one direction isn't actually a machine. It's just a ramp with momentum. For most of the last decade, that distinction didn't matter. The escalator went up, balances grew, the strategy felt validated every quarter, every year, with a consistency that made skepticism seem unreasonable. And underneath all of it, powering the whole thing, wasn't brilliant analysis or careful valuation work. It was something far more mundane, far more automatic, and because of that, far more vulnerable to reversal than the track record suggested. Here's the mechanism behind it. Every 2 weeks, across tens of millions of American workers, payroll systems process 401k contributions. That money moves almost immediately into index funds. The fund managers at Vanguard, Fidelity, BlackRock, the firms controlling trillions in passive assets, take those inflows and deploy them according to a fixed set of rules, not based on whether stocks are cheap or expensive, not based on earnings quality or economic outlook, purely based on market capitalization. The biggest companies, by the rules of the index, receive the most new money, every single pay period, without exception, without judgment. Watch what that produces over time. New money flows in, the fund buys the largest stocks in proportion to their size. That buying pushes their prices higher. Higher prices mean a larger share of the total index. A larger index share means the fund must allocate even more to those same companies next time contributions arrive, which pushes prices higher again, which increases the weighting again. Each cycle reinforces the last. The loop runs continuously, quietly, invisibly, buried inside the automatic enrollment forms and target date fund defaults of millions of retirement accounts. As of early 2026, passive index funds control more than 50% of all U.S. equity fund assets. 15 years ago, active management dominated. That shift has a specific consequence that rarely gets discussed in the same breath as passive investing's genuine advantages. A growing share of the daily buying happening in U.S. equity markets isn't driven by anyone asking whether a stock deserves its current price. It's driven by obligation, by formula, by the mechanical requirement to own whatever the index specifies, in whatever proportion the index demands. The fund manager isn't making a call, they're executing instructions. Now, there's a legitimate counterargument here, and it deserves a fair hearing. The argument runs like this. Prices aren't set by who holds stocks, they're set by who trades them. Passive investors hold and rarely transact. It's the active managers, the analysts, the hedge funds, the stock pickers constantly buying and selling who do the actual price discovery work. In this view, passive funds are simply free riding on the intellectual labor of active markets, and as long as active traders remain in the game, prices stay roughly honest. That argument has real merit, but it carries an assumption that's worth examining in 2026. Active management has been shrinking steadily for years, outcompeted by the lower costs and stronger long-term returns of passive strategies. The community of price-sensitive, analytically driven investors doing careful valuation work represents a smaller counterweight than it once did. Less scrutiny, less friction, less resistance to the mechanical buying pushing the biggest names higher. The escalator ran up because the inflows kept coming. That logic is straightforward. What's less comfortable to sit with is that the same mechanical process operates identically in reverse. When contributions slow, when withdrawals accelerate, when a shock forces selling, the fund doesn't deliberate. It sells whatever the index holds, at whatever price the market offers, without hesitation and without judgment. And when that moment arrives, there's a specific problem waiting on the other side that most investors have never seriously considered. It's not just about prices falling. It's about whether there are enough willing buyers to catch them. That's the liquidity problem. And it's been quietly growing larger with every dollar that's flowed into passive funds. Most structural problems are invisible until the moment they become the only thing you can see. The roof holds through 100 rainstorms. Then one storm hits differently, and suddenly the design flaw that was always there becomes the entire conversation. Financial systems work the same way. The vulnerability doesn't announce itself during the good years. It waits. And the passive investing boom has been quietly building one that most retirement investors have never had reason to examine until now. Here's how the plumbing works under normal conditions. When investors sell shares in an index fund, the fund raises cash by selling the underlying stocks it holds. On an ordinary day, this happens smoothly. Active managers, institutional traders, and price-sensitive buyers are on the other side of those transactions, making calculated decisions about what individual stocks are worth. Supply meets demand. The system clears. Nobody notices the mechanics because the mechanics work. Now change the conditions. A serious recession hits. Unemployment rises sharply. Markets drop 20, 30, 40%. And at the same time, because these things tend to happen simultaneously, a large wave of retirees who have been drawing down their accounts accelerates those withdrawals. Younger investors, watching their balances collapse, start selling to stop the bleeding. Institutional risk models trigger automatic reductions in equity exposure across the board, all of it converging on the same window of time. The fund has no choice. It sells, not because a manager assessed the situation and decided selling was wise, because the redemptions mechanically require it, at whatever price the market is currently offering, without negotiation and without delay. Here's the structural problem that's grown significantly larger as passive investing has expanded. The pool of active, price-sensitive buyers, investors who look at a falling stock and make a deliberate judgment that it's now cheap enough to buy, is smaller relative to total market size than at any point in modern history. Passive funds don't step in to buy during a sell-off. They're the ones selling. And with more than 50% of U.S. equity fund assets now sitting in passive vehicles, the buyers needed to absorb a large, forced, price-insensitive wave of selling simply may not be there in sufficient size to prevent prices from overshooting dramatically to the downside. The historical pattern is already visible in the data. The 2008 financial crisis was catastrophic, but it unfolded over 17 months. Painful and grinding, but slow enough that investors had time to process, adjust, and make considered decisions. The COVID crash in March 2020 was a different experience entirely. A 34% decline in just 33 days. That speed wasn't solely a reflection of how serious the underlying shock was. It was amplified by the structure of modern markets, passive funds, algorithmic systems, and rules-based selling mechanisms all operating in the same direction simultaneously, with very little human deliberation slowing the descent. The system has gotten faster. In rising markets, speed is fine. In falling markets, speed means losses arrive before most people have processed what's happening, let alone decided what to do about it. There's an uncomfortable irony worth naming here. The growth of passive investing has genuinely improved outcomes for ordinary investors over the long run. Lower costs, better diversification than most active alternatives, and returns that beat the majority of professional fund managers over time. All of that is real. And that same growth has made the system measurably more brittle under stress. The inflows that built the escalator also packed the theater. The same money did both things. So the market structure carries real risk. The liquidity fragility is real. But here's what the data shows about where the damage actually lands when a crash arrives. Because it turns out the external risks, the concentration, the feedback loop, the liquidity crunch, those are just the warm-up. The real bomb isn't in the market at all. It's in your own brain, and the cost it extracts is hiding in plain sight. The most expensive investor mistake doesn't happen in a bad market. It happens in a good one, right before a bad one hits. Because that's when confidence is highest. That's when the strategy feels validated. That's when the idea of staying cautious, maintaining a buffer, keeping some dry powder, all of it feels unnecessary and overly conservative. And then conditions shift, the portfolio drops, and the decision that gets made in that moment of peak stress is the one that does the real damage. The research on this is both consistent and sobering. The firm Dalbar has been tracking the gap between what funds return and what investors in those funds actually earn for decades. Their findings don't change much year to year because the underlying behavior doesn't change much. The average equity investor underperforms their own fund by approximately 2.5% annually. Every year, not occasionally, consistently. 2.5% sounds manageable. Compounded over time, it's anything but. Take a 40-year-old, call him Ryan, a software engineer in Austin, contributing steadily to his 401k, on track for a $500,000 balance at retirement. That 2.5% annual gap, compounded over 20 years, doesn't trim his outcome modestly. It cuts it nearly in half. The difference between the fund's return and Ryan's actual return lands somewhere around $250,000. Gone. Not to a bad fund, not to high fees, to the decisions Ryan made during the moments when doing nothing felt genuinely impossible. That's the number worth sitting with. $250,000, roughly 3 years of his salary, erased not by the market but by his own responses to it. The psychological mechanism driving this pattern has a name: loss aversion. The Nobel Prize-winning research of Daniel Kahneman and Amos Tversky established the core finding: the pain of losing money is roughly twice as powerful as the pleasure of gaining the equivalent amount. Losing $1,000 registers with about twice the emotional intensity of gaining $1,000. Feels good. The experiences are fundamentally asymmetric. What that asymmetry produces during a real market downturn is a kind of cognitive distortion that's almost impossible to reason your way out of in the moment. When Ryan's portfolio drops 40%, and at some point in a long investing career, it will, his brain isn't processing a 40% loss. It's generating something closer to the emotional experience of an 80% loss. The distress is disproportionate to the mathematical reality. And that disproportionate distress is precisely what triggers the decision to sell, to move to cash, to wait until things feel safer. The problem is that markets don't recover on a schedule that accommodates emotional readiness. They recover abruptly, without warning, and disproportionately in the earliest days of the rebound. The investors who sold during the March 2020 crash and waited for clarity before reinvesting missed the sharpest part of the recovery. The S&P 500 reclaimed its pre-crash highs within 5 months. Most people who moved to cash were still waiting on the sidelines when that happened, having locked in their losses and missed the rebound simultaneously. This is the behavioral trap, not stupidity, not a lack of discipline, just a deeply wired human response to pain, running directly against the logic of long-term investing, activated at precisely the worst possible moment. And the solution isn't trying harder to suppress that response when the moment comes. That almost never works. The solution is building a structure that makes the destructive decision unnecessary in the first place, one that removes the pressure before the panic has a chance to take over. That's exactly what the 3-step fix is designed to do. Resilience isn't about predicting what breaks. It's about building something that holds even when you can't. Everything covered so far points to the same underlying conclusion. The risk in a standard index fund portfolio isn't random or unpredictable. It's structural. Concentration in a handful of technology companies, a mechanical feedback loop that amplifies both gains and losses, a liquidity fragility that grows with every new dollar flowing into passive funds, and a behavioral vulnerability that activates precisely when markets are most violent. None of these are arguments against index investing. They're arguments for being more deliberate about how you do it. 3 adjustments, none exotic, all of them within reach of any ordinary investor with a standard brokerage or retirement account. The first addresses concentration directly. A standard S&P 500 fund puts approximately 35 cents of every dollar into 7 U.S. technology companies. The most straightforward way to dilute that specific risk is to shift toward a total world stock fund. The numbers tell the story clearly. You go from 500 companies to more than 9,000 spread across the United States, developed markets in Europe and Asia, and emerging economies worldwide. The weighting toward those top 7 U.S. technology names drops by more than half. You're still passive. You're still low-cost. Total world index funds from major providers currently carry expense ratios in the range of 3 to 7 basis points annually, which is essentially nothing. But you've stopped making a single, undisclosed, one-directional bet on U.S. large-cap technology and started owning something that more honestly reflects how the global economy actually distributes value. This isn't a prediction that U.S. technology will underperform. It might keep outperforming for another decade. The point is to stop carrying a massive concentration risk you never consciously chose. The second adjustment is a tilt towards smaller, value-oriented companies, what researchers call a small-cap value tilt. If the main index is a concentrated bet on the largest, most widely followed, most expensively priced companies in the market, a small-cap value allocation adds exposure to their less glamorous counterparts. Companies trading closer to their actual business fundamentals. Companies whose prices aren't inflated by narrative momentum or AI enthusiasm. Decades of academic research, including work that contributed to a Nobel Prize in economics, suggests these smaller value companies have historically delivered a return premium over long periods. Not every year, not without volatility, but persistently enough to earn a measured place in a serious long-term portfolio as a genuine diversifier against the big tech concentration risk sitting at the top of the index. The third adjustment is the most important one. Build a buffer. Here's what Ryan, the software engineer from the previous section, actually needs to defuse the behavioral bomb. Not better willpower, not a stricter investment policy statement, a genuine liquid cushion of cash and short-term bonds large enough to cover 1 to 2 years of living expenses without touching his equity portfolio. The specific number depends on individual circumstances, but for most people in their late 30s to mid-40s, that range is a reasonable starting point. What the buffer actually does is remove the forced decision. When the market drops 40% and Ryan's balance looks devastating, the question that triggers panic selling is always the same: can I afford to wait this out? If the answer is yes, if the bills are covered, if the mortgage payment doesn't depend on what the S&P 500 does this month, the psychological pressure drops dramatically. The decision to hold isn't heroic anymore. It's just the default. And that's exactly the position you want to be in. John Bogle, who built the index fund industry at Vanguard and spent his final years warning about the concentration and crowding risks his own creation had introduced, never changed his core conclusion. A simple, low-cost, passive approach, even with its structural flaws, still beats active management for most investors. After fees, active managers underperform their benchmark indexes roughly 80 to 90% of the time over 10-year periods. The math is consistent and brutal. The answer was never to abandon the strategy. It was always to practice it more honestly, broader exposure. A value tilt, a buffer that protects your behavior as much as your balance. The smartest portfolio isn't the one with the best predictions built into it. It's the one that doesn't require any predictions to survive. And that's exactly where this whole conversation lands. You weren't doing it wrong. The fund wasn't a scam. The strategy isn't broken. But there was a gap between what the label said and what the structure delivered, between the diversification you thought you had and the concentrated bet you were actually carrying. That gap is real, it's measurable, and now you can see it. The mechanisms worth remembering are these. Concentration compounds silently. A feedback loop that works beautifully in one direction works brutally in the other. Liquidity only becomes a problem when everyone needs it simultaneously, which is exactly when crises arrive. And the most expensive decision in a portfolio isn't usually a bad fund. It's a good fund sold at the worst possible moment. Structure beats prediction. Every time. The investors who come through market shocks intact aren't the ones who saw them coming. They're the ones who built something that didn't require perfect timing to hold together. Before the next video, sit with this question. You've spent time building your portfolio, choosing your funds, watching the numbers. But how much time have you spent stress testing it? Not against the market, but against yourself, against the version of you that exists at the bottom of a 40% crash. That's the portfolio worth building,